there are quite a few different products of whole. The most popular one that we have here at Farmers is going to be the Index Universal Life. What that refers to is this: it's a universal life policy, so it has a change per year that can be made done, except to the death benefit, but it changed where we can invest more money into the product. It boils off an index. The S&P is typically the one we recommend. That's going to be the one that has been the highest return over the last 20 plus years. But the differences between a whole and a term. So, for example, let's say we look at a couple different options. We'll say the term is a 30-year term, which means that payment stays steady for 30 years. Or we look at a whole policy. Let's say we're age 25. So let's say we were going to spend $75 on a 30-year term, or we could spend, let's say, $100 to $110 on an index universal life policy. The biggest difference is that payment will stay the same for your entirety of life. So whether you live to be 55, 85, 105, that policy will be that same payment. Difference is on a term, the term does run out at some point. If you live past the term, then that payment will go up every year according to age. And the older you get, the lot more expensive it gets. And also a lot of term policies are capped at age 80, which means at age 80, that policy is null and void. Where the average age of living here, it keeps going up and probably will be north of 80 before too long. So something to keep in mind there when you're shopping for both. What I typically recommend is that we get some sort of whole policy put into place. That way there is a chunk of money that's going to be a set payment for your entire life. Now, if we can't afford a whole policy for the full amount that we want, then I recommend supplementing that probably with a term policy during our earning years, which is going to be our working years when we're making money. That's income we need to replace. So a whole policy is going to be a little bit different on that retrospect. We're looking at long term, and a whole policy or index universal life or any of those policies that fall under the whole category are going to be typically investment earning as well. So just to give you kind of an example, on our index universal life policy, currently there is a 0% floor, which means it can't lose any money, or 8.5 to 9% cap, which means if the S&P made 22% this year, you're only going to make 8.5 or 9. But if it lost 22%, you're not going to lose any money. So it's one of those accounts that does go up in cash value. And in fact, that's the basis of most of the time we sell it. People necessarily aren't extremely interested in the life portion or the death benefit portion. They're interested in the investment portion. That one there is going to be a big one for all whole life policies. It's definitely just something to take a look at. I mean, we all try to get 401ks, IRAs, all of that type of things. So let me ask you this: if you could do an investment product that grew tax deferred and also paid out tax deferred because we paid our taxes first, would we be interested in something like that? So a lot of people say like for 401k because it's tax deferred, it's pre-tax money. Here's the issue with the 401k versus a index universal life, for example. You have to pull out at a certain age for a 401k for no penalty. With our product, if there's cash available in there, you can pull out as long as the policy stays active for no penalty. So therefore, you don't have to be 65, 67 years old and before you can pull out any money. Let's say we got this policy when we were young. Let's say we started off when we were 20, 21, for example. Let's say we bought our first house at 30 years old. Well, there's 10 years worth of cash value that could be in there. So for example, if there's $30,000 in there, let's say we needed $20,000 for a down payment on a house, we could pull out the $20,000, or we could borrow against it. Kind of like you can borrow against it on a 401k, same type of thing. You can borrow against it on a life policy, or index universal life policy, I should say. So there are some good advantages to that as well. Plus the payout at the end, let's say we passed away when we were 45, that payout's going to be tax free for the beneficiary as well. So that's a big benefit to them as well. So when you're looking at, okay, let's say I need $300,000 to cover the mortgage and a couple other bills and part of income. Well, that $300,000 doesn't mean you have to go get $400 because you need to pull taxes out of it first. It just means we need $300. So that's a big benefit to your beneficiaries on what they might need. So you don't maybe need as much as you quite think, but we need to take a look at it. Typically, you're going to want to get 10 to 12 times your annual amount of salary, but to kind of keep everything afloat, or to pay off the mortgage, pay off bills, debts, so on and so forth. So the biggest reason for the difference is going to be the investment portion. That's the reason why it's a little bit more expensive than, say, a term policy. And that's just the money you're investing along with it, for cash value. So that $300,000 policy, let's say we purchased on an index universal life policy, now could be $450,000 if we just let the money grow and grow and grow. So that $300,000 could be worth $450. If we looked at what a $450,000 term product was, typically it's going to be probably pretty close to the same amount of money. It's just forcing investment. And a lot of people, to budget correctly, need a forced investment rather than, well, I want to put $500 a month away. And what happens is bills and life get in the way. And guess what? They don't put that $500 a month away. Let's say a lot of months they only might put 50 or $100 when they should have been putting more money up front. Also, so let's say we don't have kids yet. We want to kind of build a nest egg so we can have some cash available when they go to college, as higher education keeps getting more and more expensive. We have that option to either borrow against, or we can do cash withdrawal as well. So if we build up some good cash value early, let's say by the time we have kids, that gives you, let's say you're not pregnant yet, but thinking about having a family. Now all of a sudden we probably got 20 years to put towards that goal, instead of waiting until the kid's 15, so to speak.